Joining us now, MSA Capital Managing Partner Ben Harburg. Ben, we rely on you a lot to bring us the latest from the country itself. Parse through this, if you can, for our viewers. What stimulus measures have occurred or been announced that you believe are significant and will be followed through on to potentially a positive impact on the Chinese consumer?
Well, it's a great question, and I think it's actually not a direct line to be drawn between the actual stimuli and the impact on the consumer. The key was to cause everyone to feel stable, to cause everyone to feel like there was a floor under the market, to change everyone's perceptions around the way the Chinese government would deal with the economy from being much more laissez-faire and allowing it to kind of organically grow out of its rut to one where they were going to aggressively intervene with interest rate drops, capital injections, cash handouts, interest reserve ratio requirement changes. And so all of that was to change the flavor of the market and to change the feeling in the streets of Beijing and Hong Kong and Shenzhen. And to that end, it has achieved that. People are walking around with a different pace in their step today. While I would still say it will take time for these actual changes to ripple through and for us to see them on the consumption numbers.
All right, so you're a believer that they have done enough at least to stimulate the consumer.
I think that the engine has been jump-started again. And I think the numbers coming out of, for instance, Golden Week, where people went in with a little bit more of that confidence, looked pretty good. Tourist trips were up about 6%. Spending rose about 6.3%. We saw some spurts of buying in the real estate market. We obviously saw a huge rush to the public markets. China has this deficit where, about 70% of U.S. wealth is in public markets and other forms of financial products, and only 30% in real estate. It's the exact opposite here in China. So there's huge room for that capital to flow into the market. But we're seeing that confidence slightly restored beyond what you're seeing today in the downward of the market.
But you mentioned real estate, of course, and so much of the problem, to the extent there is one there, centers on that. I mean, has enough been done? We hear these enormous numbers in terms of unrealized losses. So much confidence has been lost when it comes to the property sector and its need for a true reset, but obviously enormous write-downs. Is that really a problem that has been dealt with?
I wouldn't say it's anywhere near being done, and it's something that will take decades, if forever, to be worked out of the system, in the sense that the Chinese model of reliance on real estate and infrastructure development and that driving growth at the provincial level and nationally just simply cannot continue. And so that will take decades to be worked out of the system. What I can say is that we're not at any risk of a Lehman moment here. The NPLs are nowhere near what we had in the U.S. People's loans are tied directly to them personally, so they're not walking away from mortgages. The ratios between the LTVs are very different than we had in the U.S. during the 2008 bubble. And so overall, I don't think that is as crushing a threat to the economy, but certainly one that looms over it, and certainly for global investors scares them away and forces Chinese investors to kind of bunker down because they're afraid that their equity values are going to continue to fall.
I mean, two sort of counter bearish points to the China story right now. Number one, what is the savings rate in China? Isn't it dramatically high? So doesn't it take some fiscal stimulus to unleash that? And number two, the trade tensions impact China. We talk about the U.S., what could happen after the election, but even look at what's happening right now in Europe with the tariffs on the Chinese EVs and now potential retaliatory tariffs. I saw brandy was up for discussion. Isn't that a big headwind as well?
Sure. So, I mean, let's take them one by one. So the savings issue is monumental. And again, today the Chinese have somewhere on the order of $21 trillion of household savings sitting in their deposits, relative to only about $900 billion in the United States. To us, we look at that as an opportunity. That means that if we can find that stability and people are starting to see their public portfolios going up, and at least they're not losing money on their homes, they can bring that money back into the market. So that would actually cause me to be more bullish China and bearish the U.S. on that specific front if that confidence is restored. From a tariffs perspective, this is nothing new. We expected the tariffs will continue. a lot of the tariffs that are affecting Chinese goods coming towards the U.S. actually have a minimal impact because the U.S., for instance, doesn't absorb a lot of Chinese electric vehicles. Europe is a bit bigger, but you see the European automakers themselves are pushing back against this because many of them have formed alliances with the Chinese to co-build automotive vehicles. And so it's certainly something that will continue indefinitely, but it's not one that's going to hugely undermine these companies. For instance, BYD sell their cars for about twice the price in Europe that they do here in China. And what that means is they have a lot of room to absorb different forms of tariffs.